the butt. But anyway, so let's go ahead. So we're just going to continue with the handout. So if you pull that up, and I will pull mine up. Okay. So I think we ended up on number, I think we finished number 7. And let me get out the, I have to do something for a second. I gotta change cameras. Those are just from page 9. We had this before. Now I can share. Okay. So just kind of continuing, and again, this is journal entries are just a shorthand way of writing down a transaction. You know, instead of writing all of this out, you know, instead of doing this, we simply take the 2 accounts or 3 accounts we need and write them down. So it's a very quick way of writing down a journal entry. Okay. Number 8 and number 7 are very similar. It is a different wording. I think I did this because I think there's a part of the book that has this as the same, or a different wording. Customer paid toward their account $100. So what accounts are we going to use?
Cash.
Yep.
And account receivable, right?
Yep, exactly. Very good. Oops, let's put cash first. Okay, is the cash going up or down?
It's going up. They say customer paid cash towards. Yeah, it's going up. It's increased.
Good.
And the account receivable going down.
Yep. Perfect. Okay, so cash is going to go up, cash receivable going down. So now we have to go to this thing. Okay. I'm going to zoom this in a little. There's a way to zoom this camera electronically, but it makes the picture so much worse. So it's not worth it. Oh, that's not very good. Okay. All right. So cash, it's an asset. It's going to increase with a debit. So cash is going up via debit. Accounts receivable, it's an asset, is decreasing with credit. And you guys have kind of learned the game now, I'm sure, that if you know one of them, you know what the other one is. So cash is going up with a debit. Actually, we're going down with a credit. All right, go back. So the date is May. An asset going up. And that is debit. You don't have to put this asset plus and minus. I'm just doing that so you know how I got the debit or the credit. You can put it in the amount. Okay, so we just recorded this transaction and we just put the date in, grab the two accounts we needed, and we're done. Okay. Paid off a few accounts payable, $400.
So would one be cash?
Yep.
Cash and then accounts payable. So cash would be decreasing. And then wouldn't accounts payable also be decreasing?
Yep. Yeah, these are both going down. Yep. All right, so let's go to our table. Cash is going down. So it'll be a credit. Accounts payable is going down. So it'll be a debit. So accounts payable decreases with debits. It'll be a debit. Cash decreases with a credit. So we have our debit and our credit. And let's go back here. So accounts payable gets the, you can put them in any order you want. So liability going down. And an asset going down. And, you know, we just grab the two accounts we need to record it and then done with it. And you guys put pluses or minuses in. The debits or credits will tell you whether it's a plus or minus. Okay, this one down here is a similar one. Payments toward a mortgage payable. And you notice the mortgage, you know, mortgage payable similar to an accounts payable. So it can be the same entry pretty much, except for mortgage payable instead of accounts payable. So made a payment, which indicates cash. Or mortgage payable. Oops. And like up here, they're both decreasing. All right, cash is going down because we're paying it. And our mortgage payable is also going down because we're paying it off. So those two are both decreasing. And just like we did last time, cash is decreasing with a credit. No, we're not doing accounts payable, but we're going to do mortgage payable. So mortgage payable will also decrease with a debit like we had last time. Okay, so move this up. Again, I don't care whether you put the mortgages or the liabilities first or last. The book will say put them first, but okay. Number 11. By the way, if you guys have any questions, on any of these, go ahead and stop me. I'll, we can go over it. And don't be afraid to stop me. All right. See, purchase office equipment on credit.
So would that be accounts payable?
Yes.
And that would be increasing?
Yep.
And then equipment?
Yep. Equipment going up or down?
It's going up. And also,
Yep. So accounts payable is going to increase and equipment will increase. So we have to figure out our debits and credit. I'm going to put the date in here. Forget it. Okay, so let's go to our handy page 9 table. And accounts payable, it's increasing. So accounts payable will be the credit. At the point you can almost stop because you know the other was going to be, accounts payable is going to be a credit, you know. But let's go to equipment. Equipment is going to increase with a debit. And you already knew that from down here, but so equipment is increasing, it'll be debit. And accounts payable, it's increasing with a credit. Okay, so equipment first. Oh, that's not typing in. Why not? There you go. There's liability going up. So they're both increasing. And you remember, and that seems a little weird, like these both increase and both decrease. Remember, these are on two different sides of the balance sheet. You know, this is on the asset side. So if this side goes up, something else has to happen. So if the liability side also goes up, we're still in balance. All right. 12, purchase supplies using cash, $330. So what accounts?
supplies.
Cash and supplies, yeah, like you said.
Yep, exactly. Cash and supplies.
cash would decrease and supplies would increase.
Yep. So cash is going down. And supplies are going up. These are both assets. So if you more of one, less of other, still balances. But let's go to our table. And we have cash. It's going down, so it'll be a credit. And supplies is going up, so it'll be a debit. The date. And again, it doesn't matter to me whether you put the debits first or not. The credits first is fine. As long as you use the right account and put it, the right debit or credit into the matter. No matter what the book says. And you don't have to center. I keep centering these. You don't have to do that. So anyway, as you notice, as we go through here, these are, the first ones are kind of hard and they take more time. But as you get going, these become very quick. And you work with them every day, these become just, you can write down seconds. Okay, issued common stock for cash. So which accounts?
Common stock and cash, right?
Yep.
Both of them decreasing, right?
Actually, both are going to increase.
Yeah, it rises. I see. Yeah, I see. I'm talking. I forgot.
Oops, spell cash correctly. So yeah, so common stock is going to go up because we have more owners now, and the owners, the new owners, gave us $4,000. They bought into the business basically, and so we have more cash now. So the stock went up. These are the owners' equity, and the cash also went up. So let's see, the stock, way down here at the bottom. So common stock increases with the credit. So common stock will be the credit. Cash is increasing also. So it'll be a debit. Okay. June 23rd. Oh, what happened there? I did something wrong. Okay, so cash is going up. Debit. And common stock is also going up. Equity account is going up. And so you notice cash is with on the asset side, obviously, and then common stock is on the other side of the balance sheet. So there's no problem with those two going up. They'll keep them balanced. Both sides of the balance sheet will increase by 4,000. Yeah, that and these common stock transactions are, for most companies, are fairly rare. You know, this supplies one. This is a transaction you do all the time. This is when you probably don't do all that often. Unless it's a really big company. Okay. Received cash from a customer previously billed. 700. So what accounts are we gonna have?
Cash.
Yep.
Make account receivable.
Yep. Right. Oops, let's spell it right. Okay. Is cash going up or down?
Up.
And accounts receivable?
It's decrease.
Yep. Yeah. So they no longer owe us. You know, this is the account that they owe us from, but they just paid us. They don't no longer owe us that. So 6. 21. Okay, so go to our handy table. Move this down a little bit. Our cash is increasing with a debit. Accounts receivable is decreasing. They no longer owe us the money they paid. So the cash is going to go up, and the accounts receivable is going to go down. Those are both assets. Okay, so cash. And again, if these are unfamiliar, they should be. First time we're doing them. Actually, it's the second time we did them last class. I'm lying to you guys. But still, they're still fairly new. Okay. Paid all of the accounts payable. 1,100. What accounts are we going to use for that one?
Will that be cash and accounts payable?
Yep. And two, as we go through these, you'll get kind of used to doing, which ones they are, what you got. Oh, so is cash going up or down?
Going up. It's increase and account payable decrease.
So okay, so accounts payable will decrease. We're paying it off. What's going to happen with the cash?
It's going to increase.
Would it be decreasing as well?
It'll be decreasing. Yep. Right, because we're so we're paying off the accounts payable. So we're going to pay them with cash. So that would be 29. Let's see, 6. Okay, so cash is going to go down, which takes the asset side down, and then accounts payable will go down also, which will be the liability side. So they'll both be going down together. Let's go to this thing. Oops, went too far. Okay, so cash is decreasing. Cash will be the credit. accounts payable is also decreasing. So it'll be a debit. Okay, so let's go back to okay, so accounts payable will be the debit, it's going down. More than 100. Cash is an asset, and it's also going down.
I have a question.
Yeah.
So does it matter what order we put into the table, like the accounts payable? Does it matter if it's on the second line?
No.
Okay.
Yeah. If you put it in like this,
Just make sure they're on the credit debit, whichever they are.
exactly.
Okay.
Now
Thank you.
the book will tell you that the debit should go first. It doesn't. There is no accounting rule for that. And I've seen having worked in accounting, you'll actually see dozens of journal entries going all together, and they'll be all mixed up, debits and credits. I've actually talked to authors about taking that out of the books, because if you put it in the if you put the credits first, like in the online stuff, it'll mark it wrong, but it's not really wrong. I mean, the order doesn't really matter. If it's if you get the debits and credits right, it's a fine journal entry. But they're not going to change it. So but it really is kind of an unfortunate thing that there's no accounting rule on it. The debits have got to go first. Okay. This one's tricky. Received a utility bill for $200. Okay, so this is we received a utility bill. Now it doesn't say we paid it though, so it's not going to be cash. So what kind of an account is it going to be?
Account payable.
Yeah, good. So we're going to have accounts payable. And this is kind of a new one in that, they got accounts payable, but we didn't get cash back, or we didn't get supplies or anything like that. This is a utility bill. And so I'm going to switch to the table over here. And this is now we're going to introduce the revenues and expenses. Up until now, everything's been pretty much on the balance sheet. So this is, we're going to start doing revenues and expenses. Now, revenues and expenses for us are actually are much easier, because if it's a revenue, all revenues are credits. Expenses and costs are going to be debits. And the reason is because they increase on the debit side. For instance, let's see, revenues. Revenues increase on the credit side. As time goes on, you get more and more revenues, so the revenues keep going up. And same thing down here, expenses keep going up. What's more, 1 month's worth of rent or 2 months worth of rent? Well, 2 months. So expenses keep going up. So as you come down here, probably use utilities expense. And the nice thing about an expense, expenses are always debits. So revenues are always credits. Expenses are debits. So this is the income statement stuff. Income statement. So the income statement stuff is actually a little easier than, down here. This is the balance sheet. Okay. So utilities expense is going to be a debit. Okay, so let's go back to our. Okay, so utility bill, the utility expense, or some type of expense. Oops. And accounts payable, is it going up or down? Do we owe more or less?
More.
More. And the utility expense, these are always increasing and they're always debits. So I can put in here. I didn't say always, but it'd be very strange. Oops, to have a it is possible your expenses might decrease. If, for instance, if you overpay a bill or something, they might send you a check or something like that. But unless something strange happens, the expenses are always going to be debits. And accounts payable is liability going up. 200. So expenses are always debits. Okay, let's go to 17. Owe employees for 1 week of wages, $1,600. So what accounts are you gonna need for them? Let's take the first one. Owe employees. What is it when you owe somebody? What kind of account?
Wages expense.
Wages expense will certainly be one of them. And actually, and here's the cool thing about expenses and revenues too, but if expenses are always debits, right when you figure out that something is an expense, the journal entry, which is going to be a debit, which is going to be a credit, right? As long as you get the other account right. Now, what is it when you owe somebody? Think about the balance sheet. Oh, here, let's pull up the thing. I'm trying to do that my screen. Oh, you know what? I don't have it there. Put it in. You know what? I don't have it in here. I should have it in here. We usually have an account. You can say accounts payable, but usually we use an account called wages payable. I gotta add it to it. And that's when you owe your employees. Until you make their paychecks, you have a wages payable. don't have it in there. Well, it says any other payable, but wages payable is a very common one. I'll put that in. Okay. My fault. Let's go back. Okay, so put in wages payable. If you put in accounts payable, that's fine too. I'll take either one. Ooh. Okay, expenses, they always increase. And wages payable is also increasing. We now owe more, right? We owe these people $1,600, so the amount that we owe is going up by 1,600. And go back to here. So expense, wage expense, always debits. Liability, wages payable. Oops, going to increase with a credit, so we owe them more. So this will be the credit. This will be the debit. And again, the nice thing about expenses, well, at least for, I guess expenses aren't nice, but the nice thing about right, doing the journal entry for expenses is that expenses are always debits. And so, you know, and if you know that, again, you know exactly what the wages payable is going to be. Oops. Oops. Isn't this fun watching me learn how to type? I keep getting error messages flashing on my screen, so if I look distracted or if I sound distracted, it keeps telling me move this window away from the shared application. I'm not sure what that means. Okay. Okay, so all employees for wages, so these are wage expense. Expenses are the debits. And wages payable, we owe them wages. And until we pay them, that's going to increase our liabilities. $18 is a little bit of a throwback. We actually already did this one. Sold common stock to an investor. 3,800. It's similar to what we did earlier. What accounts are you going to use?
Common stock.
Yep. And so we sold this common stock to the investor.
Cash.
Exactly. Yep. So do we have more investors or less investors now?
Less.
Well, more owners.
More, because we sold stock.
Yep. More. And do we have more or less cash?
More.
More. Yep. We had this one earlier, just in it had a different wording. By the way, if you're wondering why I do this different wording, is that comes from problems in the book. So that we run into problems like that, it'll be something you've already seen. All right. Let's see here. So common stock and cash both increasing. So move this. So cash increase with a debit. So our cash is going up with a debit. At that point, it is, you know, and you guys kind of know the game now. If you know what the debit is, you know what the other side has to be. Credit, common stock, it increases with credits. So the debit will be cash and the credit will be common stock. And again, I don't care what order you put. I don't care which is the, you know, put the debit first and credit first, doesn't matter. Now, when you go into your next class, again, make sure, you know, you're, if you're doing stuff out of the, especially out of the online stuff, make sure you put the debits first, but it really doesn't matter. Okay. Paid dividends to stockholders, 1,800. I am going to check something really quickly here. Give me a second here. Gotta change cameras. I'll tell you what I'm looking for. There's actually two ways to do dividends. Okay. All right. So let's go. Let's put this in. So date is July 14th. Now, whenever you see the word paid, what does that indicate? What did you probably pay the dividends with?
Cash.
Cash. So cash will be one. And increase, decrease. Which one? Cash is probably going to,
Increase.
well, if you paid it.
Oh, decrease.
Yeah. So this will be going down. And the account that I'm going to put in here is dividends, which I don't think I have on this. And here's the thing about dividends is that it really depends on how they classify it. But they usually classify it as an increase. A lot of times they won't use the dividend account, they'll go right through retained earnings. Let me show you. Oh wait, you can't see my account. Hold on, I apologize. I'm being goofy here. I'm sorry. So okay, so they pay the dividends. So cash they paid. So cash will decrease. And we're gonna use an account called dividends. And they will show that as increasing. This is a little bit of a funny one though. A lot of times they'll run it straight through retained earnings. If you remember, dividends come out of the retained earnings statement as a minus. So if it's dividends, it'll be an increase. If it's retained earnings, it'll be a decrease. So, and that's why there's different ways of doing this one. And I don't have it on the table, I don't think. Positive I don't. It'd be a completely separate account. I'll write it to the side over here. I'm going to update this thing. I'll send you guys a fresh, updated, corrected one. Dividends are going to be debits. So when you have a dividend, you will debit the dividend. It's not really as an expense because you're paying this to the owners, but it's kind of the same thing. You're paying out cash if you're not getting anything back. So it's going to be, so dividends are going to be a debit. So think about dividend, debit. Both D's.
If the dividends increase or decrease, will they always be debits?
Yes. And if you think about it, if you pay owners, it'll decrease, it'll be a dividend. If the owners give money back in, they're investing more, so they'll be buying common stock or something. So it really is a one-way street. So dividends are just being paid out. They're not going to come back in. So they'll always be increasing. It's a little bit odd though, because dividends actually come out of retained earnings, which would be a decrease. And and I know this is, I mean, I know I'm just going to confuse people with this. I don't mean to, but oh, see, wait, I do have it. Retained earnings down here, dividends will be a debit. See, I'm not stupid, except that I can't read my own handout. But yeah, so retained earnings, you notice that they'll decrease with debits and dividends. They consider this increasing with a debit. And then eventually these dividends will come out of the retained earnings. Which is, long story short, let's put it in the dividends account. So dividends. Ooh, that's not right. So cash is an asset going down. Yeah, so dividends are always debit. So dividends and expenses are always going to be debits. Yeah, they're always going to increase. They're not going to decrease. The owners aren't going to give the dividends back. And cash will go down. And so, and here's the thing too, if you're doing, some transactions, and as people go up in accounting, I know some of you guys are accounting majors, but and so sometimes you'll say, well, okay, I know that cash is going down, so that's the credit, and there'll be some debit, whatever the debit is, but you'll actually know that there's going to be something on the other side of it, and you know what it's going to be. It's going to be a debit. So, a lot of times if you come right into a strange account, if you can get one side, a lot of times you can get the other. This will tell you. If cash is going down, whatever's on the other side is going to be with a credit, then the other side is going to be debit. Yeah, this is about half the books will show a dividend account, about half the books will show retained earnings. This book shows dividends. Okay. Now we're running into these are the revenues. So now we're kind of switching gears again. This is going to be these up here, and nice thing about revenues, credits. Okay, let's go back. Okay. So perform services for cash, $280. So we did some kind of service for people, whatever it was, landscaping, consulting, or whatever, for cash for 200. So what accounts are we going to use? Well, what's one of the accounts?
Cash.
Cash. Going up or down? So we did some work and we were paid in cash.
Up.
Up. Yep. All right. Now on the other side, so revenues, you can just put in revenues for any of these, for any revenues, you can put in revenues. Most companies, most businesses make revenues one way, or maybe possibly two ways, but a lot of times they just make it one way. But if you just put in revenues, that's fine. They would probably call this one a service revenue because you did a service. So, but again, if you just put in revenues, that's fine too. I'm going to put in service revenue, but just revenue is fine. And revenues are always increasing. But it doesn't really matter because revenues are always going to be credits. Look how crazy I'm going to get. I'm going to put this credit in first. See, service revenues, any revenue. I don't have enough. I know. There we go. So revenues equal credits. All right. Didn't have enough room to write all these in there. Cash is an asset. By now you're probably sick of flipping back and forth. Asset going up, and you know what it is, it's 280. That's going to be a debit. Assets go up and debits go down with credits. Uh, 21 is a tricky one. Billed customer for services delivered, 550. Okay, so we billed the customers. We did not get cash. No cash here yet. Billed them. So what accounts are we going to use? What account do we use when someone owes us money? Accounts payable is when we owe somebody else. So what account do we use when someone owes us money?
Accounts receivable.
Yep. And so do they owe us more or less?
More.
Yep. Perfect. Okay, now we do something on the other side. Services delivered. I think I use this. I think this is book terminology. What is that probably going to be? Services delivered. We did some kind of service for these, whoever this is. They don't say who it is, but we did some kind of service for them. So what kind of account is it probably going to be?
Would it be services revenue?
Yep. Yeah, we see one here. And again, if you just put revenue, revenue's fine. You really only are going to use, this these, but you want a tag in front of it if they have more than one kind of revenue. And that will always be increasing. Okay, so let's see. July 27, 21. Okay, so let's take accounts receivable. Oh, got crazy over here. Accounts receivable, it's increasing with a debit. So we know what the debit is, accounts receivable, and even easier is the service revenue. We don't, they're always going to be increasing. They'll always be credits. Okay, so let's go back to our accounts receivable. It's an asset increasing. Oops. Uh, 515. And service revenue. And again, revenues. Equal probably is a bad term, but I'll give it credits. So revenues are always credits. Oops. Yeah. There we go. Sale of services made a customer on account, 810. Sale. This is and goofed up my spacing here. Okay. Sales and revenues are exactly the same thing. See if I have it on here. Sale, yeah, okay. So this thing got blurry again. Okay, so sales and revenue are exactly the same thing. And you can use a sales account. You'll see sales account, you'll see revenues, you'll see different ones. The kind of weird one here is fees earned. That's also a revenue account, but generally sales and revenue we're going to see when money's coming in, whatever it is your business is. Back. Okay. So sales, so I'm just going to put that one in. We'll put sales in here. Sales, which is the same thing as revenue. So we made sales to a customer on account. So what kind of account? Accounts payable or accounts receivable?
Receivable.
Yep. Okay. Sales always increasing, are always going to be, and accounts receivable is also increasing. It's going to be exactly the same one as up here, except that instead of service revenue, we just put sales in. So it's the H. And you'll know, I mean, you also notice that, a lot of these are kind of varied, but in a real business, if you're running your own business, if you're running, have your restaurant or landscaping or whatever it is, you'll make these kind of journal entries every day. They'll become, like the back of your hand, maybe. So this is accounts receivable. I mean, they're hard when you first do them. And again, it's the same things up here. Accounts receivable going up. Yep. And so sales are the same thing as revenue. Those credits. Not creditees. Although if we named them creditees and debitees, maybe that would be, make them a little easier. So accounts receivable and sales. Sales are the same thing as revenues. I think this will be our last one. We'll save the last page for next class. Okay, so wages owed to employees at the end of the month, 390. We had a similar one earlier. Wages owed.
Wages expense.
Yep. And
I don't know.
Wages payable.
yeah, it could also be accounts payable. Either one of those I'll take. But the wages payable will be inside in the book. And the expense is increasing. They're always increasing, and the payable will be increasing because we owe them more now. So let's go to our crooked table, and wages expense will be a debit always. And I don't have wages payable. Wages payable will increase with a credit. So the expense will be so the expense will be the debit, and the payable will be the credit. Oops. I know there should be a wages are always payable, but there are always debits, but I don't have enough. And wages payable. So liability increasing by 390. Oops. Okay, and again, these are unusual. We know we've only done 23. Actually, first one's already done. We've only done 22 of these. So if they're still unfamiliar, they should be. The more we do, the more you'll get familiar with them, and the accounts will come easier and all that kind of stuff. Let's save it right there. So we will pick up on page 8 next Tuesday, right? Any questions?
Can we review number 8, please? I think I missed that one.
Number 8. That's my big fat head. Let's go. Number 8. And by the way, even I audited for 3 years, or for Navistar and for U.S. Steel, and I remember one journal entry that this one assembly plant had made, that they put it in the journal entry, decided that they had done it wrong, they reversed it out, so they took they entered an opposite journal entry and took it out, decided it was right, put it back in, decided it was wrong, took it back out. They did that 6 times. So, even among people that do this every day, journal entries are not always easy. They be confusing. So, and the kicker to that is that they actually put it in correctly. It was a correct journal entry. They just second guessed themselves. So anyway, but it was actually incorrectly. It was on the books correctly at the end of the year, so the financial statements were okay. But even among people that do journal entries every day, sometimes it's not so easy to know what goes where. Any other questions I have?
No questions. Are we gonna have a quiz or the exam they usually send, or no?
One more time?
You said, are we having a quiz?
We're not gonna, not for, we certainly won't have a quiz before a week from today.
Oh, okay.
And two, though, know that when I, kind of like the last one, when I do give it to you, you'll have a week to do it.
Okay, perfect.
Yeah, it isn't like, okay, you get another date or something. I'll do those. So, but yeah, so certainly, I would say I'll probably give it to you next Thursday. It would probably be most likely the earliest we would get it. Again, I'm spending more time on these because if we don't get these right, the rest of the chapter or the rest of the semester is just harder. And although it seems like we're wasting more time on this and shit, it actually saves time because it makes the rest of the semester go more quickly when people have a better grasp of this stuff. So I have no problem slowing down in the beginning. And this is all new. This is all weird, wacky, new stuff. I mean, this is, if you show most people this, they're going to have no idea what you're talking about. So, it is a strange and a new thing. So we'll take a little more time on it and, get a good base, and then we'll go on to the other stuff. Talking to the wall. Any questions?
Are we going to turn this in?
We are not today, though. We'll turn it in next class. We're going to finish this one next class, and then I'll have a drop for it. And I'll have a drop for the part 1 also. I purposely left the chapter 2 stuff off because people are still turning into chapter 1 stuff, and I don't want to get too confusing ahead of it. But we will turn in the chapter 1, the chapter 2 handout part 1, and then this one, which is the chapter 2 handout part 2. Those will both be turned in, and I'll put those both on next Tuesday.
Okay, thank you.
Any more questions? Anything else? Okay, well, enjoy the rest of your day, and I will see you on Tuesday.
Thank you. Same to you.
Thank you. Same to you.
Thank you.
Thanks, guys.
Thank you.
Thanks.